In this video, we are going to continue where we left off, which was the expanded accounting equation, which is assets equal to liabilities plus common stock minus dividends plus revenues minus expenses. We said this was the expanded accounting equation. All right, each one of these categories, you'll see when you come down here, you'll see assets, liabilities, common stock, revenue, expenses, and dividends. This matches the items up here in the expanded accounting equation. And then you'll see all of these items under each one of the categories. So this is not only these items are not only used in expanded accounting equation. You can call assets, liabilities, common stock, revenue, expenses, and dividends. You can also call these account types or the general account categories. And underneath each one of these general account types, there are accounts. So cash, accounts receivable, interest receivable, inventory, supplies, they all belong. These are accounts that belong to the asset account type, right? Liabilities. Anytime you see something with payable in it, that's a liability. Notes payable, accounts payable, unearned revenue, salaries, and wages payable. These are accounts that belong to the liability account type. And when we say accounts, account is just, think of account as a small bucket used for similar transactions. So think of assets as a large bucket, right? And within assets, you have cash, which is a small bucket within the asset bucket. So anytime a company engages in cash transactions, what do? They put it in cash. Anytime a company engages in accounts receivable transactions, they put it in the accounts receivable bucket, right? And the accounts receivable bucket and the cash bucket are part of assets. So asset is like the big container or bucket, and cash and accounts receivable is the small container or bucket. And that's what an account is. It's just a bucket that is used for all similar transactions. Okay, so the cash account tracks all activity related to cash. The accounts receivable account tracks all activity related to accounts receivable, and all of these accounts are part of assets. Same thing on the liability side. Anytime you see notes payable, accounts payable, anytime a company engages in an accounts payable transaction, it will be recorded in the accounts payable account, and accounts payable is always included in liabilities. All right, so these are your account types. And then here you have what is called the accounts that matches or goes with these account types. Okay, so again, you need to memorize these: assets, liabilities, common stock, revenue, expenses, and dividends. These are the account types, and these are the accounts. So every time you use an account, you've got to know which account type it maps to. Okay, so if I tell you prepaid rent, you've got to know, oh, prepaid rent is an asset. If I say to you mortgage payable, you got to know mortgage payable is a liability. If I say to you dividends, you've got to know the dividends is part of dividends, a dividend account type. If I say to you depreciation expense, you've got to know that's an expense. Okay, so these are the accounts and these account types. So why do we need to know which account maps to an account types? Because each account type has a certain rule. So you'll see up here under each one of these accounts, there's a T. So under assets, liabilities, common stock, dividends, revenues, expenses, it's a T. And a T is just a visual way accountants use to track transactions. And you'll see this when we get to the general ledger. So you'll notice on the left side of the T, it's always debit. And on the right side of the T is always credit. So we're going to have a lot of transactions where there's a debit and credit. Remember, the definition of a debit in accounting is the left side of the T account. The definition of a credit in accounting is the right side of the T account. So whatever definitions of debit and credit you had in the past, forget about those in this class and know debit is left side of the T account, credit is right side of the T account. Now notice the arrows. So notice for assets, debit, there's an up arrow, and for credit, there's a down arrow. When you go over to liabilities, debit is a down arrow and credit is an up arrow. And here's what that means, and this is important. Anytime you have an asset account, when you increase, which is the arrow going up, an asset account, you put it on the debit side. So I can create a T for an asset account. When I want to increase the asset account, I put it on the debit side. For an asset account, when I want to decrease an asset account, I put it on the credit side. So asset is on the debit side to increase, to decrease is on the credit side. For liabilities, it's the opposite. When I want to increase a liability, I don't debit it, I credit the liability. Why? Because the arrow is going up. And then when I want to decrease a liability, I debit it because the arrow is going down. And you will see the same rule or a similar rule for each one of these items. So what you need to know is whenever you have a cash account, if I say to you, your cash account is increasing, you've got to know cash belongs to an asset. How do I increase an asset account? I debit it, right? Common stock belongs to the common stock. How do I increase a common stock account? I credit it, right? So that's key. So what I want you to remember out of this lecture, right, the account types, assets, liabilities, common stock, revenue, expenses, and dividends. Each account type has a list of accounts that are associated with them, right? So each one of these, every time you use an account, it must belong to an account type. An account is a small bucket, the category is the big bucket, right? So an account just tracks similar transactions. Also, each one of these account types has a rule, a T account rule associated with it, where the debit is going to have the arrow going up or down, or the credit is going to have the arrow going up or down. Remember, debit is always the left side of the T account, credit is always the right side of the T account. And so when you have an asset, when you increase an asset, it's debit, or you put it on the right side of the T account. When you decrease an asset, it's a credit, and you put it on asset, it's debit, you put it on the left side of the T account. For assets, when you decrease its credit, you put it on the right side of the T account, okay? And that's how that works. So let me show you how T accounts work. So here we have a T account, right? And you just put, you create a T and you put the name of the account. And like I said, right, the cash account is an asset account, and it increases with the debit, decreases with the credit. So here's cash. If I said, well, cash increased by $10,000, where would I put that? I would go ahead and put that on the debit side, right? And if I said cash increased again by $20,000, I would put it on the left side. So anytime you see something on the left side for cash, because cash follows this rule here, right? It's on this side. Now, when I have a decrease in cash of, let's say, $5,000, where would I put it? I would put it on the credit side, or the right side, okay? So that's basically how T account works. When you want to increase whatever the account is, you put it on the left side for assets, and when you want to decrease the account, you put it on the right side.